If you've ever looked into investing, you will most certainly come across this risk warning. The value of investments can go down as well as up, and you may get back less than you originally invested. It's on websites, adverts, product flyers, practically everywhere. And if you're new to investing, it can feel pretty alarming. But here's the thing, that warning isn't there to put you off investing, it's there to make sure you go in with your eyes open. Because investing does involve risk, and pretending otherwise would be dishonest. What the warning doesn't do though, is explain what that risk actually is, where it comes from, and what you can do about it. And that's what this video is for. Hello, I'm Brian, and I'm here with MoneyFarm. And today we're going to look at what investment risk really means, why it exists, and crucially, what you can do to manage it. Let's dive in. To understand investment risk, you first need to understand what makes investing different from saving. Now, when you put money in a savings account, the amount sitting there doesn't change. It grows slowly and predictably through interest. But when you invest, you're putting your money into assets, things like shares in companies or bonds, and those assets don't have a fixed value. Their prices move up and down depending on a whole host of things. How the economy is doing at that particular time, what's happening to interest rates, political events, company performance, and even how confident investors are feeling at a given moment. Now, because all of these things are constantly shifting, and because we can't predict the future, we can never guarantee how an investment will perform. So that uncertainty is what investment risk is. But here's the other side of that coin. That same uncertainty is also why investing has the potential to grow your money in a way that cash savings often can't, which means that investors accept that uncertainty, that risk, in exchange for the possibility of greater returns over time. So in a nutshell, risk and potential reward are two sides of the same coin, and you can't have one without the other. It's worth noting that whilst cash savings feel safe, they carry their own risk too. Inflation. If the cost of living in the UK rises faster than your interest rate, your safe cash is actually losing buying power every year. Investing is often the tool we use to try and outpace that. Now, a lot of people assume that investment risk simply means losing their money, but it's more nuanced than that. Investment risk is really about uncertainty, specifically the possibility that your investments won't perform the way you hoped, or that they'll fall in value, particularly in the short term. Now, the technical word for these ups and downs is volatility, which means how much an investment's value move around over time. A highly volatile investment might jump 20% in value one year and drop 15% the next. A less volatile one moves more gently in either direction. Shares, for example, are generally considered more volatile than bonds, and within shares, those in smaller companies or emerging markets tend to be more volatile than shares in large, well-established companies. So as a general rule, the higher the potential return, the higher the risk. Now here's something important to understand about volatility. When the value of an investment falls, you haven't actually lost that money, not unless you sell at that point. If you leave your investment where it is and give it time to recover, that loss may only be temporary. And this is why investing is generally considered a long-term game. The longer your time horizon, ideally 5 years or more, the more able you are to ride out the inevitable ups and downs without being forced to sell at the wrong moment. When it comes to risk, however, there are a couple of more concepts that are worth noting. One important thing is that a bumpy ride and a bad destination are two completely different things. An investment can be highly volatile, meaning it moves around a lot, but it can still deliver strong returns over the long run, as the discomfort of the journey doesn't necessarily tell you anything about where you'll end up. On the other hand, a bumpy ride doesn't automatically mean the destination is worth it either. High volatility is only worth tolerating if the potential return justifies it, which is why understanding what you're invested in and why matters just as much as being able to stomach the ups and downs. Another important thing to remember is that not all investments carry the same level of risk or the same potential return. Think of it as a spectrum. At one end you have cash and cash savings accounts, low risk but low return. Move along the spectrum and you get to government bonds, then corporate bonds, then shares in large established companies, and at the far end, shares in smaller companies or emerging markets that have higher potential returns but significantly more volatility along the way. Now, understand understanding where different investments sit on that spectrum is one of the most useful things you can do as an investor. Closely related to volatility is a concept called drawdown, which is simply how far an investment falls from its peak before it starts recovering. If an investment reaches a high of £10,000 and then drops to £7,500 before climbing back up, that's a 25% drawdown. Knowing the typical drawdown of an investment gives you a much more concrete sense of what you're signing up for, not just in the abstract, but in actual pounds and pence. And then there's a relationship between risk and time. The same investment can look very risky over a short period and considerably less risky over a long one. And that's because time smooths out volatility, and the short-term dips that look alarming over 2 years tend to become much smaller wrinkles when you zoom out to 20. So your time horizon, how long you're investing for, is one of the most powerful tools you have for managing risk. The longer you can leave your money invested, the more you can afford to absorb short-term volatility without it mattering much to your final income. So, as we mentioned, you can't eliminate investment risk altogether, but you can certainly manage it and take steps to reduce it. And one of the most powerful tools for doing that is something called diversification. Now, you've probably heard the phrase, don't put all your eggs in one basket. In investing, that's exactly what diversification means. But why does it matter? Well, imagine you put all your money into shares in one company. You believe in it, you've done your research, and you're confident it'll do well. Maybe it does, and in that case, great. That conviction paid off. But what if it doesn't? What if its sector hits a rough patch? What if a competitor takes its market share, or a change in regulation hurts its profits? Any number of things could cause that single investment to fall in value, and if everything is riding on it, your finances take the full hit. Now imagine instead that your money is spread across dozens or even hundreds of different companies in different sectors in different parts of the world. If some of them struggle, the others might hold up, which means that the gains elsewhere can help offset the losses, and your overall portfolio becomes much more resilient. Well, that's what diversification does. It basically smooths out the ride. Now, let's say we know that diversifying is important and so on. How do you actually do it? Because let's be real, diversifying properly on your own would be a huge undertaking, as buying shares in hundreds of individual companies would take enormous time, considerable cost, and you need to be constantly managing the markets as they change. Well, the good news is that there's a much simpler way. Funds. A fund is essentially a bundle of investments, sometimes dozens, sometimes hundreds, that you can access through a single purchase. Put money into a fund and you've instantly spread your investment across everything inside it. Now, there are a few different types of funds worth knowing about. Actively managed funds, sometimes just called funds, are run by a professional fund manager whose job is to research the market and pick investments they believe will outperform it. And they come in all shapes and sizes, covering different regions, sectors, and asset types. And because of that active management, they tend to charge higher fees. ETFs, short for exchange traded funds, work differently. Rather than trying to beat the market, most ETFs simply track an index, like the FTSE 100 or the S&P 500, mirroring its performance. Because there's no active stock picking involved, they tend to be significantly cheaper, and they can be bought and sold throughout the day, just like shares. Both approaches allow you to diversify across a wide range of investments in one go, making them a very efficient way to spread and manage risk. And that breadth is exactly what makes them useful for managing risk. But here's the thing, funds give you breadth. Breadth helps manage risk, but the right combination matters. And what determines the right combination comes down to a concept called correlation. Two investments are correlated if they tend to move in the same direction at the same time. Now, if you own two highly correlated investments, say shares in two companies in the same sector, when one falls, the other is likely to fall too. So you might think you've spread your money, but in reality, you haven't really spread your risk. True diversification means combining low correlated investments that don't all move together, so that when some parts of your portfolio are falling, others may be holding steady or even rising, which cushions the overall impact, not because any one of them is safe on its own, but because together they behave differently from one another. As I've mentioned already, how you invest is a personal choice, so there isn't one way to diversify. If you're a more cautious investor, perhaps because you're investing over a shorter time frame, or maybe just because you don't have the stomach for taking too many risks, you're likely to hold a bigger chunk of bonds in your portfolio than someone with a higher risk profile. Now, it's worth noting that there's no right or wrong answer, as this depends on things like how long you're investing for, what your financial goals are, and how comfortable you are with the idea of your investments going up and also going down in value. Someone investing for 30 years can generally afford to take on more risk than someone who might need their money in 5. And someone who finds market volatility stressful might sleep better with a more cautious portfolio, even if that means potentially lower returns over time. It's also worth thinking not just about returns, but about risk-adjusted returns. Now, two investments might deliver the same gain over the same period, but if one took you on a wild ride to get there and the other moves steadily upward, they're not really equivalent. A strong return achieved with lower volatility is generally preferable to the same return achieved with far higher risk. So when you're evaluating investments, the return figure alone doesn't tell the full story. The key is to understand your own situation before you invest and to make sure the level of risk you're taking on feels right for you. If you're not sure where to start, some investment firms, including MoneyFarm, offer managed portfolios where a professional team takes care of all the investment decisions for you, building a diversified portfolio that's matched to your goals and your attitude to risk. So let's bring all of this together. Investment risk is not about gambling or recklessness. It's the natural uncertainty that comes with putting money into assets that can go up and down in value. And it's the same thing that gives investing its potential to grow your wealth over time. You can't avoid it entirely, but you can manage it through diversification, through investing in funds, and through matching your approach to your personal goals and time horizon. And there you have it. Everything you need to understand about investment risk. I hope you enjoyed this video, and if you did, please subscribe to the channel and have a look at the description where you'll find more on MoneyFarm and how to invest. And as always, I look forward to seeing you in the next video. Bye-bye for now.